The markets are making history for all the wrong reasons. We've had the biggest 3-day bond drop since 1987's Black Monday and the second largest bank crash in US history in less than 2 days. You're not the only one who's confused. Some of the sharpest minds on Wall Street think the whole system is breaking down before our eyes. Well, this channel is about giving you access to information. Our friends at Masterworks are giving you access to an under the radar asset that could give you returns while other markets are plummeting. One that paid out over $25 million in total to investors last year. It's blue chip museum grade art from legends like Picasso and Banksy. Art like this increased in market value on average 29% last year. It wasn't just a flash in the pan either. Contemporary art pieces have more than doubled the S&P 500's total return over the last 26 years. This market used to be one of the hardest to get into, but Masterworks allows investors like you to diversify with paintings from legendary artists like Picasso, Banksy, and Monet without needing millions of dollars. Masterwork has built an impressive track record of 12 exits, all of them profitable to investors. With those kinds of results, Masterworks has seen over 680,000 users try to gain access, so there is a wait list. But I reached out to them to give you all VIP access to their latest offerings. To skip the wait list, just check the description below. What to make of the data? Welcome to Real Vision Daily Briefing. It's Thursday, April 13, 2023. I'm Ash Bennington. I'm joined today by Mark Ritchie II, manager of RTM3, analyst at Minervini Private Access. Hey, welcome back, Mark. Pleasure to have you as always.
Great to be back. Good to see you, Ash.
So, Mark, interesting day. Lots cooking, gold prices to talk about, PPI data, and lots going on in equities. What are your thoughts? Big picture, where are we right now, Mark?
Yeah, really good question. If we start with the equities, it'd be good to back up in terms of, say, the last time I was on, which I think was right around the beginning of February. I want to say February 2nd or 3rd, which almost topped the market in terms of the short term. And what I was pointing out then was that the rally off the lows had some considerable breadth. And I think I used the word firepower in terms of what looked like a potential character change in the market that had me pretty constructive. Well, things have gotten more nuanced, more mixed, lots of cross currents from there. And I would start by pointing out we really have a split market in terms of equities. And the best way to describe that is just sort of look at the NASDAQ and then look at the Russell. Depending on which lens you're looking at the market through, you're going to interpret it very differently, at least if you look at the technicals. So yeah, we can go from there, anywhere you'd like to, Ash. But I think, if you think the Russell is the market, which would be it's a broader cross section, it has given back the entirety of the rally. Small problem though, you've got the NASDAQ, or on the other side of the coin, you got the NASDAQ. Looks like it may want to break out and move higher here. So, happy to get into how I look at that, how I'm handling it and dealing with it.
Yeah, well, let's jump in and talk right about that, about the divergence between equity markets here in the U.S. in terms of the indices. Why Russell 2000? What is the characteristic of that smaller cap index that you think makes it so important?
Well, the biggest thing is that it's the largest, sort of cross section of the market, and as I've often said, it's a good gauge for risk appetite. So if you and I are on the risk committee of any institution and we want to put on more risk, well, where's the riskiest area in terms of equities? Smaller mid-cap names. They're a little less well-known, a little less followed. There's more potential there for alpha.
Right.
Obviously, the other side of the coin being a lot more potential there for risk. And what we really had after that rally in February, and if anybody remembers, I was saying, if I want to see that the market to potentially broaden out in terms of participation. So the Russell was leading off the lows, which was very constructive. Well, it rolled over. Now it's back below all its major moving averages. And a lot of that, of course, was on the heels of all that really nasty news we had in the SVB, Silicon Valley, and Signature Bank. Well, the Russell is full of a lot of small banks and related financials, and even the whole idea of, do we have a credit crunch coming? What companies are going to be most susceptible to having to refinance debt at rates that are going to put a lot of pressure on their potential business or even their future. Well, the Russell is loaded to the gills with those type of potential companies and risks, where the NASDAQ, especially the NASDAQ 100, if you look under the surface, it is really being held up by those mega cap type names, which tells me that right now the equity market, again, depending on where you look, by the way, the Dow and the S&P are kind of sitting in the middle. So NASDAQ is your lead dog, Dow and S&P are sort of in the middle, and the Russell, if you were just looking at that, you'd be calling for new lows.
Right.
Who's going to win out that tug of war? And it doesn't mean that one necessarily has to win. That's another important point. Right now, I would say if you're going to be constructive or bullish on stocks, you need to be selective. I was hoping that the breadth was going to continue to broaden out after January's advance into February. That has not happened. In fact, even if you look at the leading NASDAQ in terms of the participation below the surface, as of today, only 40% of the stocks in the NASDAQ are in long-term uptrends and intermediate term, meaning only 4 out of 10 stocks are above their 50 and 200, which tells me that the majority of the strength is held in a very few number of issues, i.e. the herd is thin at this point.
Well, let me ask you about exactly that. Let's talk about big cap tech for a moment. I'm looking on my screen right now at XLK Technology Select Sector Spider Fund, looking on a year-to-date basis, up over 21%. What's your take on that, the companies that comprise it, and the broader environment and ecosystem in which they exist?
Well, to the point about risk appetite from before, right? People don't want to broaden out from, go out the risk curve at all. We've seen it compress. Well, if you're a long only manager and you have to put money to work, are you going to go with Old Faithful, a stock that that feels a little bit safer, or something that's a little bit more risky? Specifically, though, Nvidia is clearly your liquid leader right now. I think some of that is an AI sympathy play, as AI has just kind of gone bananas. And are there any pure plays in AI? Very few. So, and Nvidia at least seems to be in pole position fundamentally. Depending on who you listen to, like they're providing a lot of the chips that are going to be needed in that whole AI revolution. I would be watching that closely to see, does that consolidate? And this is where, like I said before, when stocks and equities go on a run, you want to see how do they act when they pull back. And the heavy mega cap names are really the only things that have acted well. If those crater, the whole market's going down at this point, or at least going to probably retest lows. But there's a very real possibility that we continue to be range bound, or you can have, advances that are led by few names. We saw that throughout 21. Right. So I'm not saying the market can't go higher. Those names can put the market on their back, drag the indexes higher, sort of kicking and screaming. But what's going to wind up happening is if you don't own those or own the index proper, you're going to, almost have this feeling of a disconnection. Like, how am I not making any money yet I'm reading that, the market is sort of going higher? And that's sort of the devil's always in the details when you hear that, the market went up today and people look at their portfolio and go, well, I didn't make any money. What happened? Well, it's because, when you have cap weighted indexes and you have some of these big tech names that are just behemoths that make up such a large percentage, you have to either decide I'm gonna if I can't beat them, join them. I've got to have that type of exposure. The catch-22 being, though, if then those take a rest and we see rotation out, it's what makes these grinding type sideways rotational markets much more challenging, because you feel it's like 2 steps forward, 2.5 back, and you're getting bounced around. And where the healthier the advance, it's just sort of like, the rising tide it easily lifts more boats.
Well, this is kind of interesting. I was thinking as you were saying this about this idea of folks crowding into a smaller number of names as a sort of a security play. You do start to wonder. I mean, S&P 500 up year to date about 8.5%, 8.4 on my screen right now, and you got to wonder when you see 21+% on XLK. Does safety exist if everyone piles into the same trade and it gets crowded and it gets overbid? I mean, it's a real question.
That's a great question. And the other point I was going to make in terms of does safety exist? This was the point I was making all last year, was there was nowhere to hide. As equity markets were just kind of going down. This is why I would be an advocate at times for cash. Cash is safer than anything else. That if 22 didn't teach you that lesson, then nothing will. Because if you were long vol, long gold, long bonds, none of them worked. Cash was kind of the only thing that sort of helped you. But right now, this is where I'm continuing to hold higher than average levels of cash because I'm just not seeing, that stronger wind at our back for the time being. And just to make that other point, you made the point. Okay, Nasdaq's up close to 20, S&P 8, Russell flat. Maybe even down a little. I didn't look at it today. So very, very divergent in terms of the overall performance. Well, that would be more indicative of at least a bear market rally, not the big, at least for now. The lows are potentially still in. The problem is, where are you going to allocate the capital, as it's been bumpy and rotational? And if you haven't been in, the NVIDIA type names, you're probably not seeing that, 20%, up type performance, after the first quarter.
Well, now we're getting into the old question, cash is king or cash is trash, depending upon your views of inflation. Let's talk a little bit about that, because we got PPI final demand out today, an interesting number. PPI FD month over month. The consensus on this was 0. Consensus range from minus 0.1 to 0.2 positive. The actual quite a bit lower than both. Minus 0.5%, minus 0.5% on a prior of minus 0.1. So clearly deceleration there. Year over year basis, 2.7. Now there's some base effects in this prior month, 4.6. But also, I just want to talk about this for a second, because ex food and energy month over month, the consensus was 0.3, a consensus range of 0.2 to 0.3. These both positive. Actual print, negative 0.1. Inflation moderating quite a bit. Any thoughts on that? And by the way, then we can transition this conversation into gold, talking of inflation.
Well, for starters, obviously, and there's been a lot of macro folks on Real Vision who are smarter than I and following that have been sort of calling for this, that, look, the boogeyman of inflation is sort of already died, maybe a few months ago, if not further. And, the risk now shifting to, rather than the Fed being behind the curve, have they overcooked the turkey in terms of over tightening? And the latter point, or that remains to be seen, I think. But clearly, yeah, inflation looks like it's slowing. Powell even said in his last presser after, that, hey, we have more sort of tightening in the system already from the ongoing hikes that they've done. Well, you're starting to see that bore out in the data. And I think the market, though, is really shifting its focus from, have we, for lack of a better word, slayed inflation, but now is the economy, going to slow down responsibly, or have we slammed on the brakes to the point that we're going to go into the windshield or maybe through the windshield in terms of economic growth? And this is where I think it's really most interesting, where there weren't a lot of playbooks that made sense last year. And I think you could make the same argument here, given that, because since the Silicon Valley Bank news kind of hit, I think that sort of was a little bit of a turn, right? Where everyone said, okay, maybe our focus shouldn't just be inflation, in terms of like, this tightening is now really starting to come home to roost. And where I would go with that is to say, so look what happened in yields. Short-term yields, clearly, in terms of price bottom, yields look like they peaked. And if you have, I sent over a chart on that. That was the biggest move we had, since that beginning move, in the beginning of 22. And if you look at the sort of reverse correlation, bonds were not a flight to quality at all last year. In fact, bonds were the problem, right? As rates were rising, it was causing this yield compression dynamic where it was forcing selling in stocks. Well, is it possible that as that reverses the other way, well, stocks no longer have yield compression as a headwind? The question is going to be the counterbalance in terms of recession risks, meaning how bad is this going to be, the other way, where But is it possible that, again, if stocks are looking out 3 to 6 months, that pullbacks might be shallower if they're anticipating that the Fed is going to have to sort of switch its stance? And that's where I think the devil is really going to be in the details there to say, if the Fed goes, yeah, we're going to kind of go on pause, but then let a little bit of a lot more pain in the economy sort of happen before they become accommodative again. A little difference, say, going on pause versus saying we're going to provide liquidity. Now, they did provide liquidity with this whole banking program. So even what does it mean to really provide liquidity, I think, is going to come into sharp contrast as well. But, I would say it's very possible stocks might continue to be volatile. But I think as long as rates, have come off and potentially peaked, I would say in the intermediate term, that's going to be a bullish driver for stocks.
Well, that's certainly the speculation based on market-based metrics of forward yield projections. We still have folks from the Fed talking about rate hikes. It's important to point out via John Williams from the New York Fed saying that essentially that he thinks one more may still be appropriate. So we may still have that as a headwind, at least in terms of tail risk to think about. But I wanted to shift gears here into an adjacent topic, a related topic, gold price. Right now, gold on my screen looks like 2040. Headed toward an all-time high here. Mark, what are your thoughts?
Well, let me start by saying I historically have a love-hate relationship with gold. I would jokingly say that I love to hate it because it's been one of these assets that is always floated as, the great refuge and savior and all these kinds of things. And generally, I jokingly say I hate to invest in it and like to trade it or love to trade it, because the primary reason for that, though, being, Ash, is we have not had a cyclical bull market in gold in over a decade. In fact, if you even study historically bull markets, and what I mean by secular, obviously some of this is semantics, but if you're not making regular new highs or all-time highs in an asset, I would argue you're not in a secular bull advance. Well, if you look at the chart that has sort of been floating around on Twitter really for over a year is this big massive base cup and handle. If is the term I would use. Other people use their own definition for how you want to define technicals. Look, it's been in a range now since the peak in 2011, and the only rallies we've had have been more of a cyclical nature. So if you weren't a little more tactical, you probably didn't do well or you got bumped around. And I'm saying today, literally, as you said, we're potentially close to kind of making history. Whenever markets are doing that, you should at least be paying attention. And, I don't normally give short-term tactical advice, but even this rally off the lows has been tough to participate in. You've had one pullback that probably shook out a lot of the loose hands, and then we ripped right back after sort of that Silicon Valley Bank news. And what's interesting, though, if it was just a flight to safety, I would have expected gold to sell back off, and it stayed bid, which tells me that there are definitely interested buyers. And if you look at the volume, it hasn't been explosive, but it's been constructive, which tells me right here, I think, is an interesting spot. Where if we really are breaking out here, I would expect gold at least to run to 2,300, 2,500. And the first pullback, shakeout, or consolidation should be a low-risk buy potentially. And I'm also starting to see gold equities trade better, which is a really good sign. I like to take my, again, cues from the individual equities to form my overall view on the market. We're starting to see more gold stocks hit the relative strength new highs list, meaning they're trading better than other competing equities. Anybody will tell you precious metal stocks have been in the doghouse for a while, because again, we haven't had a secular bull market in the underlying asset. Now, why is that happening? I'll leave that to some of the macro guys, but this is where the market is a leading indicator for me. So when historic breakout happens, you can sit there and ask questions and go, well, until I make sense of it, I won't participate. Or I pull out my risk management playbook to figure out, is there a way to play this from a low risk standpoint where I can participate?
Talking about some of the technical signals here, I wanted to bring in us a different view, a different perspective on this, I should say, from Francis Hunt. This is a conversation that I had with Francis. It's live on the Essential Tier today. This is from a show called The Deep Dive, an upcoming contraction in broader energy complex, but it's about gold. Let's take a look right now.
So in reasonable time frame, we're seeing the secondary high and the all-time high fall, in our opinion. So this is a bad, and why is this happening? We're seeing distribution out of US debt. So there's a dollar confidence crisis, but people have got to remember, currency is borrowed into existence. This goes hand in hand with debt markets. So there's actually also a bigger problem. There's a debt possible problem. So China no longer feels the need to treasuries. If they're doing bilaterals with Brazil to engage in yuan, that means less dollars are needed on hand as the global currency. So you've heard a lot of this theme now, and it seems to have stepped up. And one of the biggest beneficiaries is not another fiat. It is, hold on a minute, whilst there's this challenge to the main fiat, the god of fiats, call it the dollar, maybe we should be stepping out of the fiat game because there's no clear depth provider to the level of the dollar, but clearly the dollar is under threat. Gold is benefiting in this environment, and debt is having a problem generally of late. However, more recently, we've seen that little dip on debt, the yields that show that the yields might drop a little bit. So there is a bit of peak, there's a bit of pivot nerves around. And I think maybe 25 basis points more out of Powell because you wouldn't want to look too soft. But there's even a possibility that there's not much more before there's some form of breakage in the system.
Mark, we were talking a little bit during that clip offline about what was happening in your view in terms of Francis's opinion. Any thoughts you'd like to add?
Well, I would just point out that, and I mentioned this, I think, back in February as well, that it makes a lot of sense to me that gold might get flows. And flows ultimately are driving these markets. And so historically, from my understanding, institutions have been underweight gold to very underweight gold for quite some time. And, I made the point in terms of 60-40, if people are even rethinking that to say, hey, let's reallocate some money to precious metals, that's going to put a big bid, underneath gold. Obviously, all the things with, all the information about central banks and, the strength of currencies and all that kind of thing is relevant. I would say if you look at the dollar relative to gold most recently, so we had this rally and a pullback, the dollar has not made new lows while gold is pressing on highs. Well, it tells you it's not just a dollar phenomenon. Talk to somebody else in the gold industry. I'm not an expert, but somebody who deals with bullion dealers, and they said all of their dealers currently are saying we can't get the metal fast enough, meaning the demand is unlike anything we've seen. And I said, is even more so than, say, post-COVID? And he said, absolutely.
Interesting.
Now, again, I would never trade just on that. But when, somebody who is in that market is saying, I don't know that I've seen this cocktail before, and you have a chart that looks like that chart that's breaking into new highs. And I would also say the Commitments to Traders report is not, it isn't screaming bullish, but it's not screaming that we're anywhere close to a peak either. Commercials have a net short position. Anybody who follows someone like Peter Brandt would say normally they wouldn't want to go against the commercials, but they don't have a huge net short position. And if that starts to move the other way, they're going to be buyers right alongside. And the specs are not limit long, which would tell me even last year's pullback probably just rinsed retail out of the market. And if we start seeing all-time historical new highs in gold, every gold bug newsletter on this planet is going to be screaming, buy 6 ways to Sunday. Whether or not that brings the retail guys back in, you'd probably want to be, I would want to be lightening up into a move like that and then looking to buy it. But, my general rule is when you see some type of a historic breakout, the first shakeout is probably a buy. Or the first base. So, right now, that's what I'd be looking for, tactically speaking. Again, though, I want to look for ways to get on board something without having to, take a stop or risk management that is 5 miles wide. And I'm saying that's why I think you should be watching gold right here. If I'm wrong, we come right back into the range, and it's chop suey like, every other time. If I'm right, to borrow from Rage Against the Machine, it's going to be bulls on parade for probably the next 6 to 18 months.
It's so interesting you make this point about this kind of just incredibly dense, rich mosaic of data that we have. You reach a point where we have the amount of information that we do about markets and commodities now, where you're never going to have every indicator pointing in exactly the same direction, except under the most extreme of conditions. You're always going to have, on the one hand, X, on the other, Y. And it's our job to try and sort it out and figure out what means what.
Yeah, I mean, that's a really good point. And I often say, if all the information was there, you definitely shouldn't go with it because it's perfectly priced. And that's one of the challenges actually with a market like gold, because it's, I don't know what the notional value, multi-trillion-dollar asset, it tends to be efficiently priced, which means oftentimes these breakouts to new highs, everyone's selling, they're not buying. And so when you see a big market like that move into historic new highs, you should sit up in your chair at least and take note, because those moves can be powerful. And if people are caught offside or bulls are sold out, they're going to have to, come back to the table and start buying.
Here's an interesting question. We've got them coming in right now from the audience, rolling in, and I wanted to just jump on some of them because we got some good ones here today. TrillionX on YouTube wants to know, how about a short NASDAQ, long Dow strategy? I'm going to date myself here and make myself sound older than I intend, but I remember back in the late 90s, early 2000s, when I was one of the young guys working on Wall Street, I remember we would have these days where you'd have NASDAQ jump considerably and Dow sell off, as people were literally selling sort of the old brick and mortar stocks and jumping into the new, at the new time, so-called internet stocks. You have this interesting relationship between the indices. Any thoughts on that, whether there is a play to be had there, whether there is a strategy, as the questioner wants to know, shorting NASDAQ and going long the Dow?
Well, for starters, that is probably not for your inexperienced folks, but certainly, and that's something, I used to trade that spread occasionally myself, but I would use it when they consolidate. But it's basically, what he's saying is a version of the fact that tech isn't mean reverting. Landlines aren't coming back. Dial-up isn't coming back, meaning that the sort of old guard companies are going to continue to be disrupted, and assuming again that your leaders are in the NASDAQ. But I wouldn't just be buying and holding that spread either, because it could get very volatile at times. That's where, again, risk management being prudent. If you want to trade that, I wouldn't be against it.
Yeah, Monkey Boy just added to this. Hopefully, this market doesn't end up like Limp Bizkit.
That's a good joke.
I still have a landline. When I moved into this new apartment, I got a landline. Never bought a phone. Never hooked it up. But somehow, I don't even know what the number is. I don't even know my own phone number. That's where we are with landlines.
Right. Again, they're not coming back, Ash. I hate to tell you.
Okay, here's a question that comes just from Monkey Boy from YouTube. So is cash still king? We were wondering about this earlier. Or is Bitcoin the new big bad boy?
Well, getting into crypto, for starters, I'm still holding a decent amount of cash, more than 50% cash right now. So even in a position like gold, if I'm getting involved, and I have a small position on now, but I'm again waiting for an opportunity to get heavier in what's a low risk way. So I wouldn't, to be clear, not just go limit long or put your whole portfolio in gold. I think some allocation may be prudent there, and it looks like money's rotating there. In terms of Bitcoin and crypto in general, I will say this, again, as not getting into the fundamentals. I'll leave that for everything Real Vision does, and Real Vision Crypto. The price action is impressive to me. And the reason I say that, and Ash, you're better to comment on this than anybody, when the headlines are terrible and markets can't make new lows, that is valuable information. I don't care what anybody else says. If you actually trade markets, anybody who's worth their salt will tell you it's not the news, it's the reaction. And I think it was last summer, Ash, you and I were actually on shortly after the whole Luna blow up.
Yep.
And the headlines from then, you tell me, have they gotten better or worse?
Well, this is a really good point. I can tell you this. If someone told me what the headlines were going to be over the last, call it 90 days in the crypto markets, all the negative stories we've seen. Let's go back actually, maybe to November of 2022 when we began to see this latest, the FTX collapse and all the things that happened after that, DCG and all the other stories, and said, okay, here's a pen. Write down the price where Bitcoin's going to be in April of 2023. I can tell you this, I would not have a number for Bitcoin that was higher than 30,000 where it's trading right now.
I think most people would have predicted sub 10 or at least new lows. To your point about November. And I am standing here with everybody else saying, I've been telling people, stay out of it, because again, just looking at the price action. Well, the last really month and a half was very telling to me. The minute you had stable coins even breaking pegs over that one weekend, and both Bitcoin and ETH, the primary assets in that digital asset ecosystem, or sort of the 1-2 gold and silver of crypto, if you will, immediately went to recent highs within a couple of days. And I tweeted about it saying, this looks like a slingshot to me, where stops are run and then immediately a market trades back to new highs. That is bullish. And we have only gone higher since. And I think we've only had maybe 2 days of pullback along the whole way. I know ETH broke out a little bit today, post Shanghai Accord, and I'll let you guys, talk about, why in terms of fundamentally that might be. But I'm saying when a market, you throw all the bad news at it and it can't go lower, it means everybody's sold out. So there's nobody but buyers left. And liquidity is not very good, so it hasn't taken a lot of buying, in any of these markets to move things around. So to me, I'm waiting for, I own some, personally, a sort of long-term kind of thing. I'm again tactically, I don't have a big position in either, but it's one I'm watching for. And if we get, say, some type of bigger base, where really even in the last crypto bull market, I would be looking for some type of a repeat. If you look, we bottomed at like, I can't remember, it was about 3,000 or something. But then if you look at the chart, it didn't really set up until it was in that sort of 8 to 10K range. And then once you broke out from there, again, the bulls were on a stampede. And it would be the same thing I would look for in gold. You want to look for meaningfully, prices to close, higher than 2050 for several weeks. In the same way, if we can continue to see prices hold and close above 30 to 35. There's probably a lot of technical resistance if you look at the charts too. Whenever a chart's running off the bottom, you want to look left for supply. Well, if you look left on a Bitcoin chart right now, a lot of overhead supply between, or trapped longs between 60 and 30 that might be lightening up. And the higher it can run into that, I think the more constructive it is. But gun to my head, I would say 9 times out of 10, this market has bottomed.
Yeah, and it's interesting if you roll back the clock one more year to November of 21, flirting on those all-time highs, bumping up against the 69,000 mark, and you see all the news flow, it'd be very hard to write down those prices. Such a good point when you see the narrative and the data sort of diverge.
Absolutely. So I would say right now, look for what assets even within that ecosystem are trading better than Bitcoin and ETH. I don't have any must-watch technically right now, but it's more on my radar right now than it has been really in the past year. Because if you looked even over before this recent rally, we're just kind of bumping along lows, and that's not how I like to look at things. I'm again looking for that relative strength. Where is money flowing? And I'm saying for whatever reason, money looks like it's flowing back to at least some of the key assets, and if that continues, that's what's going to get me, more heavily tactically involved as a trader on the long side.
Mark, this has been a true cross-asset show. We've touched on just about everything: commodities. We've talked about crypto. We've talked about U.S. equities. We've talked across sectors, across indices. Final thoughts, key takeaways that you'd like to leave our viewers with here today.
Well, I'll be watching one for that dynamic I talked about between Russell and NASDAQ. And for anybody who's a bear, you want to see Russell make new lows. And if you're a bull, you want to see NASDAQ take out these recent highs in this consolidation and breadth improve. In gold, I want to see multiple weekly closes at or above this level. I think that tells you we have a new floor right around 2000 that you can potentially trade or invest against. And then crypto, we just covered it.
Mark, thanks so much for joining us. Always a pleasure to have you with us.
Great to see you, Ash. Thanks for having me.
Thanks so much for watching the Real Vision Daily Briefing. We'll be back at the same time tomorrow with Brent Donnelly. Tomorrow, we'll be extending RVDB for all our members. You won't want to miss these. So if you're not a member, sign up with the QR code on screen or by using the link in the description below. Come be part of this incredible community. We really do have a lot of fun, I should say. Thanks again. Have a great Thursday night. See you soon. This episode of the Real Vision Daily Briefing has been brought to you by Masterworks. Invest in blue chip art from the likes of Basquiat, Banksy, and Picasso for as little as $50. Skip the wait list by heading over to masterworks.art/realvision to learn more and get started investing in an asset class that doubled the S&P 500's total return over the last 26 years. That's masterworks.art/realvision.